70%. Just look at that number for a second. It represents a concentration of power so extreme, it's basically a single point of failure for an entire global market. And while most of the world was asleep, that single point, it fractured. Now, what I'm about to explain isn't some forecast or a wild theory. It's an event that has already happened, and its shockwaves are really only now beginning to ripple outward. Right, 70% of the world's investment-grade silver flows through the refineries of just one single nation. Think of it like a global artery responsible for supplying industries, mints, and investors all across the planet. And basically overnight, that artery was clamped shut. We're going to break down exactly how this happened, why it happened, and most importantly, what it means for the physical metals market from here on out. They're already calling it the 2 a.m. decision. With absolutely no warning, the Swiss government invokes emergency provisions and halted all major silver exports. I mean, shipments were literally frozen at the border. This wasn't some slowdown or a new tax. This was a full stop, a move made in the dead of night, which tells you the crisis was so severe that officials felt they couldn't even wait for the sun to come up. Okay, let's really dive into the mechanics of this. Separating these kinds of critical signals from all the daily market noise is exactly what we focus on here at Bullion Signal. So if you're interested in understanding what truly moves the needle, consider subscribing. Now, let's unpack the three converging crises that forced this completely unprecedented decision. So, to really get the scale of this disruption, you first have to understand why Switzerland is the indispensable heart of the physical silver market. It's got nothing to do with mining. Switzerland doesn't produce a single ounce of its own silver. It's about something way more critical: trust and refinement. For more than a century, they've perfected the process of turning raw, lumpy metal into the globally accepted standard of value. The supply chain looks deceptively simple. Silver gets mined in places like Peru, Mexico, and China. It's then all shipped to just a handful of refineries in Switzerland. There, it gets purified to 99.9% purity, cast into bars, and stamped with those hallmarks that are trusted all over the world. From there, it's sent out to every corner of the globe. Every single step of this process relies on Swiss efficiency and reliability. An industry insider put it to me this way, and it's a really crucial point to get. For the physical market, the names PAMP, Valcambi, and Argor-Heraeus, they're everything. They aren't just market leaders. For any large-scale physical delivery, they are the entire game. And at 2 a.m., the rules of that game were fundamentally rewritten, not by a competitor, but by the Swiss government itself. So the big question is, why now? What forced such a drastic move? Well, it wasn't one single event, but actually three crises hitting all at once. The first domino was pushed on January 1st, a long way from Switzerland. It all began when China made a sudden and decisive change to its export policy, and that created a massive, immediate hole in the global supply chain. Just look at how quickly this thing escalated. January 1st, China, a huge producer, just halts refined silver exports. A big chunk of that metal normally feeds the Swiss refineries. By the middle of January, those same refineries are reporting critically low inventories. Then, just a few weeks later, with their supply buffer totally gone, the Swiss government pulls the emergency brake. This timeline just perfectly captures how fragile the system really is. The numbers here are just staggering. China's decision instantly vaporized an estimated 120 million ounces of annual supply from the market, and a lot of that was destined for recasting and stamping in Switzerland. With global demand already through the roof, Swiss inventories, which are supposed to act as a buffer, were just completely consumed. They were shipping out metal almost as fast as it was being produced. By the second week of January, the combined vault inventory across the three major Swiss refineries had reportedly dropped to just 8 million ounces. Now that sounds like a lot of silver, right? But it's not. The global market burns through that amount in less than a week. At that rate of depletion, their vaults would be bone dry in a matter of days. From a national security point of view, that was a totally unacceptable risk. All right, let's move to the second pillar, which shows how this supply problem really quickly morphed into a financial and political crisis. This is all about the immense pressure that was building between the Swiss refineries and their most important industrial customers across Europe, turning these long-term contracts into massive financial liabilities. To make this really concrete, let's just look at a real-world example. You've got a major German solar panel manufacturer. They have a long-term contract to buy silver from a Swiss refinery. Now, these contracts are the bedrock of industrial supply chains, right? They're designed to guarantee supply at a stable, predictable price. But in a volatile market like this one, that stability can become a trap. So what's really fascinating here is the massive gap that just blew open. The German company, they had locked in a price of $82 an ounce, but with the supply shock, the open market price for physical silver shot towards $150. So for the Swiss refinery, every single ounce they ship to Germany is an ounce that can't sell on the open market for nearly double the price. We're talking millions in losses on a single contract. So you can see the impossible position this created. The Swiss refineries are facing this enormous financial pressure to just default on these low-price contracts and sell to the highest bidder. But at the exact same time, European governments, especially Germany, are calling burn and demanding that they force the refineries to honor these agreements to keep their own critical industries from shutting down. And this isn't just about solar panels. Silver is absolutely critical for electronics, medical devices, EVs, you name it. It really makes you wonder what other industries have this kind of hidden vulnerability just built right into their supply chains. I'd be really interested to hear your thoughts on that one down in the comments. It's a critical question for our modern economy. This brings us to the third and, frankly, the most important pillar. The one that ultimately pulled the trigger on the 2 a.m. decision. When faced with a global crisis, Switzerland did what any sovereign nation would do. It chose to protect itself first. This wasn't a market decision. It was purely an act of national self-preservation. Now, here's something that isn't widely known. For the last 18 months, Switzerland has been quietly building up a strategic national reserve of silver. They recognize just how important it is as a critical industrial commodity. Their target was 25 million ounces, but when the China crisis hit, they were only about halfway there, with just 12 million ounces secured. And this slide just lays bare the brutal math that Swiss officials were staring at. They had their 12 million ounces in the reserve, plus the 8 million left in the refinery vaults. So that's 20 million total inside the country. But their strategic goal was 25 million. And if exports kept going, that 8 million ounce buffer would be gone in days, leaving them short in a world where supply was just evaporating. You see, the question being asked inside the government was simple. What happens if our own industries need silver and the vaults are empty because we shipped it all abroad? As the source here notes, the Swiss government doesn't like uncomfortable answers, so they acted. The 2 a.m. freeze was the answer. It keeps all current and future refinery output inside the country until their own strategic needs are met, period. So, with the valve shut off right at the source, the shockwave now travels downstream. And this is where the logistical reality of the freeze starts to hit everyday businesses and consumers. This isn't theoretical anymore. It's a series of predictable failures that are now locked in and are going to play out over the coming weeks. First, you've got the bullion dealers. Most of them operate on a just-in-time inventory system. Their scheduled replenishment shipments, they're now stuck. So within 2 to 3 weeks, you should expect to see out-of-stock notices everywhere. Next, government mints that rely on those Swiss refined blanks will see production grind to a halt. And finally, industrial users without their own stockpiles will face shutdowns. The dominoes will fall, and they'll fall in that exact order. And honestly, this is exactly why our community at Bullion Signal is growing. People are just tired of the hype and the speculation. They want to understand the underlying mechanics of the market. An event like this, a real logistical breakdown, is so much more significant than day-to-day price noise, and our viewers really appreciate that focus on what truly matters. What this all means is that the entire conversation around physical silver has now completely changed. For the last decade, the main question for any buyer was, am I getting a good price? The market is now shifting to a fundamentally different question. Can I even get it at all? Price starts to become secondary when simple availability is the real issue. So, we've laid out the mechanics of how this critical supply chain broke. We've seen the three pillars that led straight to the 2 a.m. decision. But the story doesn't end there. Not even close. The most important question now is what happens next. How will the markets and all the people in them react to this new reality of scarcity? In part 2, we're going to dive into the next phases of this crisis and uncover the hidden signals that you need to be watching for.